Hi, everyone. Welcome to the webinar today. My name is Alexandra Alvarado. I'm the Director of Marketing and Education here at the American Apartment Owners Association. We're so happy to have you with us. We're going to cover today real estate funds and Delaware statutory trusts. We have our speaker with us today, Steve Haskell. Unfortunately, his camera's not working, but if those of you who have been on our webinars with Steve before, maybe go off of memory what Steve looked like. Steve is going to be on audio, and fortunately, his screen share is working. So we are going to proceed with the presentation. What we'll do today is we'll have about short 30-40 minute presentation, and then we'll go into questions for Steve. If you do have questions, please put them in the question box, not the chat, so that we can keep better track of that. And also, we will be recording this whole thing and sending it to you tomorrow along with Steve's information. So if you did want to get in touch, you'll be able to do that after the webinar. So Steve is with Cove Capital Investments. He is the senior vice president. He works with 1031 exchanges and also direct investment clients. And he's been doing this for quite a while. Before that, he served as an officer in the United States Air Force, and he has a lot of experience even prior to that in business. And so we really always find something new from you, Steve, that you bring to the table. So he's very good at explaining these concepts in a very concise way. So hope you all will stay tuned. And Steve, thank you so much for coming on and talking to our group again.
Thanks so much, Alexander. It's always great to come on. And I appreciate the opportunity to specifically to talk about debt-free investment opportunities right now. So it's interesting. K Properties started out with Dwight K going out on his own around the recession of 2008. Before that, he worked at other real estate investment firms that specialized in the Delaware Statutory Trust and some other types of syndications, which is what we do, the Delaware Statutory Trust, as well as some real estate funds. And during the recession, he saw a lot of struggle, a lot of pain, like many others in the real estate industry. But then as they recovered, he saw a lot of those same properties that people actually lost money on recover and do extremely well as you worked your way through 2013, 14, 15, and beyond. And so he came to the conclusion that one of the major reasons that some of the people got really wealthy and were able to hang on, and why some people lost, was one, due to the leverage. A lot of the clients didn't have the holding power to get through a tough time due to being overly leveraged or having difficult caveats and loan agreements in their mortgages, and also going into cyclical assets and highly volatile assets. So when the market got hot leading up to 2008, cap rates compressed, cash flows dropped, and in search for yield, a lot of sponsors and investors started going into riskier asset classes like hotels, assisted living, oil and gas, and things like that. And it didn't seem risky at the time because the market was doing great. And but 2008 came, and as Warren Buffett says, the tide rolled out, and everyone saw who was wearing swim trunks and who wasn't. So basically, Dwight K developed our investment thesis, where we try to stay as debt-free as possible, because most of our clients are looking for holding power and they're looking for income, and they're not really looking to get rich anymore. Real estate is has been great for getting rich, and there's always volatility, there's always risk, and a lot of people have lost a lot of money, and you can lose money in our properties too. But it's been one of the reasons that people were able to do so well in real estate is because of how easy it is to buy real estate with leverage. You buy more property, you can scale, get more upside potential, and up until the last couple of years, you can actually get higher cash flows. But things have changed, and now our investment thesis that we're positioning our clients for holding power, trying to mitigate risk as much as possible and focus on keeping our clients rich, so to speak, rather than getting them rich, has become a more powerful strategy than ever. And additionally, there's been some other benefits that have arisen for investors that are looking at debt-free, which is what we're going to get into today. So we have two main methods of investing in debt-free property. One is the Delaware Statutory Trust, and one is the LLC, or a fund. Each of them have two separate but interesting ways of potentially preserving capital and providing predictable income and modest appreciation on the back end. That's our goal. Now, these are private securities, and we're governed by FINRA and the SEC, so there's some caveats. You can lose money, right? And also, unlike just real estate you buy on your own, in private securities like DSTs and LLCs, you have to be an accredited investor. And that's generally described as having a net worth of $1 million, excluding your primary residence. And accredited entities, you read here, only generally described as an entity owned entirely by accredited individuals or an entity with gross assets of $5 million. So what that means is, if you're using an entity, it must have $5 million of assets in order to invest in DSTs, or all of the owners of that entity must be accredited. And make sure you speak with your CPA if you're not sure if you or your entity are accredited, but we're happy to discuss that further with you as well if you give us a call. The information in this presentation is prepared only for educational purposes and does not constitute an offer to purchase securities, DST properties, and or real estate. So you must have a private placement memorandum, which is only available to accredited investors and accredited entities. IRC Section 1031, IRC Section 1033, and IRC Section 721 are complex. And therefore, you should consult with your legal and tax professional. As I'm not a CPA and my team of registered representatives are not CPAs, we cannot give tax or legal advice. And we don't want any of our materials that we provide to be interpreted as tax or legal advice. So please speak with your own tax advisors. And also, there are material risks. You can lose money in real estate, including our investments, DSTs and LLCs that we provide, can lose money. And but when you remove debt, it definitely mitigates that risk. Okay, but the DST and the LLC do not shelter real estate investments from economic conditions. So it's important to note. And also, anything that we talk about today as far as scenarios or case studies, they're hypothetical and not intended to use as actual investor situations. Okay. So, and we're going to talk about diversification. That does not guarantee you against losses. So each of the investors or situation is going to vary. So please speak to your own CPAs, like I said, and advisors. All right. Past performance does not guarantee future returns. And once again, cash flow can stop, real estate can go down in value, etc. Okay, now let's get into it. Real estate funds. Now, there's a couple different funds that I'm going to actually mention later in this presentation. The concept behind this is to buy debt-free real estate on a continual basis. Now, debt is, I'm going to be honest, debt is great in real estate. It's easy to leverage. You're leveraging against a tangible asset, and you can get that asset at times to pay down the loan. So basically, you're making money off of other people's money, and real estate, relative to other asset classes, can arguably be considered the best asset class to do that with, right? Well, that's great if the market is going up and appreciating. But if you're in a deflationary market, that can lead to catastrophic risk. And we saw that during 2008, and a lot of office buildings are seeing that right now, as many REITs are handing back the keys to these facilities and the banks are taking them back over. Now, potentially, these properties could survive if there wasn't a bank that you had to hand the keys back to, and then you could push through, reposition the assets, later on and sell them for a much higher profit down the road. So that's the holding power I'm talking about. Okay, so and that kind of holding power is something that you potentially might not get in stocks, right? Where you're seeing a lot of volatility up and down in its paper. It could go away and you're subject to the sentiment of the stock market. Also, a lot of people are going into our funds trying to get away from that volatility. A lot of our clients are trying to find an asset class that's as predictable as possible, and they're not finding that in stocks and bonds right now. Another reason that clients are looking at our funds and kind of getting out of the markets and the bonds is because they are looking for an opportunity to hedge potentially against inflation. And you can potentially do that with the appreciation that comes over time with real estate, unlike many of the cash management accounts or muni funds or something like that. So right now, there's a lot of opportunities out there, and I use them myself, where you can get virtually almost risk-free income through cash management accounts and CDs and things like that, and they're paying pretty good, relatively speaking. But if the market goes up and you have an inflationary environment, you're getting 4.5% potentially, but you're not getting the appreciation of the stock that you could theoretically get from real estate, right? Also, real estate has depreciation potential that can potentially offer tax efficiencies that a lot of these other investments don't have. So that's why we're seeing a lot of folks leaving the stock market, leaving the bond market, and then electing to invest their money in debt-free funds. All right, so in these funds, typically they're LLCs, and you're owning a fractional piece of real estate. And so what they do is they continue to buy real estate over time. And this real estate is generally income producing. So these funds are spitting off currently income to investors right now on a monthly basis. And the reason I put my money in these funds is because right now it's debt-free real estate seems like at the income that we're getting them, it seems to be a pretty decent income relative to the risk that we've been seeing. So I thought, okay, well, I'm gonna put some money into these funds. But additionally, what I like about them is they continue to buy real estate over time. So as the market drops, the funds continue to buy real estate and virtually cost dollar average using other people's money as they come in. So theoretically, if the market continues to go up, great. My money that I invested goes up in value with appreciation on the property. But if the market goes down, sure, my real estate investments that I made in this fund could also potentially be going down in value. But in the meantime, other investors are coming in and buying real estate at a discount. Therefore, theoretically, cap rates are expanding over time. So the cash flows on these properties as the market drops is getting higher and higher. The rents relative to the price of property are getting higher and higher. Therefore, theoretically, the income on these funds go up as the market goes down. So if the market goes down, there's more opportunities for these funds to produce higher income for me. As the market goes back up, sure, the cash flow may go down, but the value of my investment theoretically goes up. So it's kind of an inflation and deflation hedge. And that's really the big reason why I'm personally putting my money into these debt-free funds right now. Minimum investments are typically $50,000 to $100,000. And so, as we mentioned earlier, you must have a private placement memorandum for these funds, and you have to be an accredited investor, which we already discussed. So now I want to go back into a little bit more. Here's net lease income 18, where I have some of my family's money into. So these are typically debt-free net lease assets. Net lease means commercial buildings. So think of Amazon, think of FedEx's, think of Walgreens, CVS's, right? Things like that. Big credit tenants with long-term leases. And this particular fund is targeting an 8% preferred return. And Cove Capital is a sister company of ours, and they are reviewing all these properties and are underwriting them. They have asset managers and analysts. They're constantly trying to find the best properties for this fund. And as money comes in from investors, they continue to acquire assets such as these you see here in the presentation, in this little file, this image that you see on the slide. That's really the type of assets they're targeting. And then this, for the Net Lease Income Fund 18, they're looking at stabilized assets, not many moving parts. And it's a fund that just they continue to potentially grow over time. Now, when you see 8% preferred return, that doesn't mean that it's cash flowing at 8%. I've been getting close to it, but not 8% the last couple of years. The 8% preferred return means Cove Capital cannot participate in the appreciation until me, an investor, gets at least 8% per year on my money. So if they sell this after 5 years and I only get 7% each year in cash flow, they have to give me my principal back plus 1% per year. Since I didn't get 8% per year, I only got 7%. And then they get to do, I believe this one is a 30-70 split, where I get 70% of the appreciation after that, and Cove gets 30% of the appreciation. It might be less. It might be a 25-75 split, but I'm going to be conservative here, and I think it may be 30-70. Anyways, so that's the Cove Net Lease or Cove Income Fund 18 LLC. Now, similar to that, there is a multifamily fund that Cove has called Multifamily 28. And in that one, instead of net lease assets, it's targeting multifamily assets. Now, unlike commercial, multifamily prices have been holding pretty strong. But I believe I read there's about $1 trillion of variable rate loans that are coming due over the next few years in multifamily property. So we're expecting a little bit of a pullback in multifamily. And when they do, this fund is standing by in attempt to pick up these residential properties at a discount. So that's why it's very opportunistic in strategy. And they do this debt free. So if the market continues to slide, they're not going to have to worry about a bank. They're not going to have to be worried about a bank sweeping the cash flow or the revenue, or they're not going to have to worry about any foreclosure risk or any balloon loans coming due. Or if they want to sell the properties at an opportune time, they don't have to worry about prepayment penalties or anything like that. All right, moving on. All right, now we're going to go into DSTs a little bit. But before we do, I do want to talk about a little more about the debt-free fund. So we do have an opportunistic fund 75 that's much like it's like a combination of multifamily 28 and net lease fund 18. Okay. Oops, let me go here. Where it is going to target both net lease and multifamily together. But where these two funds are looking at more stabilized assets that they can buy at a discount, the opportunistic 75 are for those that are looking for a little more potential upside and a little more potential cash flow, but it's still debt free. So we're looking at maybe buildings with lesser credit tenants that they can swap out for stronger tenants. They're going to be looking for maybe shorter term leases that they go in and negotiate and extend the leases. And they're comfortable taking on this risk because they don't have a bank to worry about. And they're using capital from investors rather than bank loans, so they can take their time, wait for the right properties. And if the properties struggle for a little bit, they don't have to worry about losing them to foreclosure. And the investors that depend on the income, don't have to worry about the bank coming in and doing what's called a cash flow sweep. Now, you see a lot of times in REITs or a lot of other funds that have bank loans, if the revenue drops under a certain amount that we call a debt service coverage ratio, the bank could come in and hold on to the money and sweep the cash flow until the revenues on properties surpass that debt service coverage ratio, go up beyond a certain point. During that time, investors aren't receiving any income, and a lot of our clients depend on that income. So staying debt-free is a good option for those type of investors. And the opportunistic 75 has a 10% preferred return and is intended to be somewhat of a mix of assets that include net lease as well as multifamily, like you see here in Multifamily Fund 28. Once again, but more targeting assets that have a little more volatility potential. So those looking at stable, debt-free, conservative type investments, the net lease 18 and multifamily 28 are interesting options. For those that are okay with a little more volatility in their cash flow, something like the opportunistic 75 would be a better option. Remember, cash flows can always go up and down. You can lose money in these funds, but if you don't have a bank lending on these properties, then the chances of losing money to foreclosure goes down to nothing, and just the losing money in general definitely goes down quite a bit compared to the leveraged assets, especially during a recession. In fact, the sponsor is kind of looking forward to a recession because in these debt-free funds, they've got nice, stable, strong assets that are most likely going to withstand that recession and outlast it. And this recession is going to provide them with a lot of buying opportunities, right? So we had Coke Capital just found one long-term net lease asset with a big credit tenant in California for a 7.5 cap that they're putting in these funds, right? So these are the type of opportunities that we haven't seen in a long time that are finally starting to present themselves. And our investors are going to receive some of the benefit of that. All right, DSTs. Now, DSTs, unlike funds, are mostly for folks that are 1031 exchanging out of their properties and into real estate, debt-free real estate. Okay, so this is a DST presentation that I'm going to kind of skip through because we only have 7 minutes left. But our DST investments are for folks that want to get out of active management and they want to go in to passive investments. And in a DST, we buy, or our partners buy properties, stabilize them, put them in a trust, and our clients sell their properties, 1031 exchange, and buy a piece of this trust. It's very much like the funds that I already communicated, but you cannot 1031 in and out of funds and LLCs. You can 1031 in and out of DSTs. And we have DSTs with debt for those that need it, and those DSTs without debt for those that don't, and those that want to stay debt-free and really position themselves for holding power. Okay, so a DST property is simply any real estate held for business or investment purposes that is held title to using a trust, a Delaware statutory trust. And there is an IRS ruling, IRC 2004-86, that allows investors to 1031 exchange out of investment property and into a DST that's held for investment purposes. Okay, I just got a message from Alexander that says I have a full hour. So make sure I get everybody's understanding on track so we can fully get the benefit of DSTs and understand the risks here. All right, so and I'm going to go through some examples here. So if you want to look up to see, hey, give me some proof that the DST qualifies for 1031 exchange, then take a look at IRC Revenue Ruling 2004-86. LLCs do not have that benefit, and neither do things like real estate investment trusts. DSTs are unique. All right, next slide. All right, so now I mentioned before, I'm talking about debt-free, but some DSTs do have loans on them, and it's nice because if you have let's say half of your property that you're selling has a loan on it, say 50% loan to value, you have $1 million property, $500,000 mortgage, you can sell that property. $500,000 will be available for you to reinvest after escrow pays off the bank. Then we can either have a DST or a portfolio of DSTs that have built-in debt of 50%. So you can then take $500,000 that you have in your qualified intermediary account, put it into one or a portfolio of DSTs, and that will buy you $500,000 of debt, $500,000 of equity, and $1 million of property. Don't have to sign for a loan. Don't have to, doesn't show up on your credit report. Don't have to do any of that. It's just automatically built into the DST. The property is held as collateral. The company that put together the DST, called a sponsor, they sign for the loan. So you can still risk bank foreclosure on your property, but they can't come after you personally, okay? So one of the benefits of DST is there. So, and here's something that's somewhat similar about DSTs to the funds that I discussed, but also a little bit different. The DSTs, their goals are to generate predictable and enduring income for investors, just like the funds. But one of the difference between DSTs and funds is in a DST, the investor is entitled to their pro rata share of whatever net operating income and potential appreciation is on the property. So there's no preferred returns in a DST. If it goes up 300%, then the DST investor is entitled, their investment goes up 300%. Unlike the funds, where in a preferred return, there's a split. After a 10% return, for example, per year, the investor has to split the upside 30-70 or 25-75 with the sponsor. Okay. Now, the nice thing about DSTs and not having a preferred return is you get all that potential appreciation and potential income. However, it can be argued that that preferred return incentivizes the sponsor to really drive up the return on the properties so that they get rewarded for a job well done. All right. Now that structure where the DST gets the investors get 100% of potential appreciation and income, that's different than LLCs, as we mentioned, but also partnerships and REITs. Usually those other entities all have what's called waterfall expenses or preferred returns on the back end that eat into that upside potential. So when you're looking at the difference between these funds and these DSTs, remember that the funds, a little more dynamic, you can continue to buy property, you can flip property, you can do things like that. And the sponsor is going to try to really ramp up the upside so that they can partake in those returns. In a DST, they're very stable. There's not a lot of moving parts. You can't buy and sell real estate within the trust. What you see is what you get. It's more boring. But you can 1031 in, you can 1031 out of a DST, unlike a fund. And the investors are entitled to 100% of all the potential net operating income and appreciation on a DST. So different strategies for each. But in both, it's for both the funds and the DSTs are opportunities to invest passively. So there's no tennis toilets and trash. There's active professional managers in place. And then investors are able to just kind of get away from property management altogether and go do the things they love with the people that they love. Now, DSTs have $100,000 minimums for 1031 exchange and typically $25,000 minimums for cash investments. Okay. So here are some of the asset classes that you may have in DSTs. Multifamily, office, industrial, medical, triple net will go into that. You can diversify all over the country. Now, also a difference between the fund and the DSTs is the funds get a K1 at the end of the year. DSTs get a 1099. So the DSTs are more like what you get from your property management companies. It's gonna go on the Schedule E of your tax return for a DST, and that's where you take the depreciation and so forth. And if you have basis in a DST, you can continue to depreciate your asset, and in a fund, there will also be depreciation, and that will show up on your K1. We already talked about the financing in the DSTs. All right, now let's go a little more into debt-free. So what we're seeing right now in different funds and REITs, and the one thing that I'm really concerned about is refinancing. I'm really concerned that a lot of these funds and REITs that are out there that have debt and have been around for 7 to 10 years are going to have balloon loans that are coming due. Balloon loans, typically with institutional grade real estate, are loans that the entirety of that loan is required to be paid back at a certain date. So where many of us go buy a house and have a 30-year mortgage, well, they buy a 30-year mortgage, so a loan that amortizes at 30 years potentially, but all of it is due at year 10. Or they'll get an interest-only loan, and all of it's due at year 10 or year 7, typically. And I think a lot of those loans are going to be coming due. And when they are coming due, the banks are going to be refinancing at a higher interest rate, which is potentially really going to eat in to the cash flows of those funds. And when that happens, then the distributions of those funds and REITs are probably going to go down, and which is tough when you have a family or a couple that are retired and depend on that income. You don't have to worry about that refinancing risk when you're debt-free. Additionally, on debt-free real estate, the worry that you don't have to have is having strengthen your balance sheet for the bank. So a lot of these REITs, the requirements, or they're going to experience requirements from the bank that they didn't have a few years ago. They're going to have stronger balance sheets than they did when they originally got the loan, which means they may have to sell off assets and liquidate at an inopportune time in order to refinance on their fund. That could lower the value of the overall investment. Okay, you don't have to worry about that when you're debt-free. Now, heading over to the DST side of things, number 3 here, if you take on debt in a DST, which you can do, you're going to have to stay in debt when you 1031 exchange because you have to buy property of equal or greater value. When you are debt-free, you can stay debt-free, and then you can have the option later on if you want to take on debt. So some of my clients that are more aggressive and they want better tax efficiencies and more upside, they say, Steve, I don't mind taking on debt. And so which I usually push back a little bit and I say, okay, I understand. But right now, the market's very unsure. Interest rates are going up or have gone up quite a bit, and the market's slowing down. Do you want to elect to take on debt when we're potentially in a receding market and values are going to be going down? Not only that, but expenses are going up with insurances and labor and maintenance, which is going to hurt your net operating income. And if you hurt your net operating income enough, the bank can do a cash flow sweep and take the rest of the revenue on the property. Okay, so a lot of risks with debt that people don't tell you about until you really dig into those loan agreements. All right, so number 4, we already talked about on here, which is a flexibility to hold through a financial or any other kind of crisis when you're debt-free. And the cross-collateralization is also something that's interesting. So funds and REITs that have a single loan across the portfolio may be diversified. But what they don't tell you is when a loan is cross-collateralized, it means that if part of the portfolio struggles, the bank can sweep the cash flow of the entirety of the portfolio. Therefore, the investors will receive no distributions until those troubled properties recover. So you're not really that diversified from an income point of view. So if you're debt free, you don't have to worry about that cross collateralization and you're truly diversified. All right, number 6, no cash flow sweeps. We already talked about that. All right, we know what that is. All right. So this is new. Number 7, higher potential cash flow. So up until the last couple of years, you could take on more leverage because interest rates were lower than cap rates. So the more debt you took on, the higher your cash flow potential was on an investment. So since interest rates have been jacked up 300%, that's no longer the case. For most properties, the interest rates are higher than the cap rates, which means the more debt you take on, the lower your cash flow is. So folks that are looking for income, specifically those that are getting into retirement mode, debt isn't really conducive for their risk profile at all. They're getting more risk and they're getting less income typically. Now, there is potentially more upside potential in the end, but most of our clients, they don't care what happens 7 to 10 years from now when the properties are sold. They want their income now. They already made their wealth. Now they want to preserve it and they want income from it. Now is the time that we've realized for debt-free investing. Now we've been K Properties, we've been a little bit of the black sheep of the industry because debt has been touted so much throughout the industry. And at K Properties, we have been telling people for the last 10, 12 years to stay debt free if they can. But now debt free is really come into style because the incomes are potentially higher. And most of our clients are in retirement mode. And that income is the most important thing, income and preservation of capital. And when it comes to being debt free, that's the two most attractive options or offerings is higher potential income and higher preservation of capital. So good time for debt free. And that's why I'm talking to y'all. All right. Now, the type of asset classes that we work with, multifamily, triple net, healthcare. We have government buildings, debt free, as mentioned, but we also have leverage for those that need it, especially for 1031 exchanges, and zero coupon. So zero coupon options are properties that are super high leverage, like 80%. And what we use those for is for folks that have a 1031 exchange that have a little bit of debt, we might take a little bit of their investment and put it into a zero coupon that has ultra high debt so that we can go into debt-free assets for the rest of their 1031 exchange. Therefore, only exposing a small amount of their transaction to foreclosure risk and utilizing the rest of their exchange into much potentially safer real estate investments that do not have loans. All right, so we talked about having to be a accredited investor to invest in these DST properties. Please speak to your CPA. And then we're going to go through, here are some options here of DSTs that we've had, debt-free. So these are specifically debt-free properties that we've had in the past as DSTs, but we also buy properties like these for our funds. So big credit tenants, multifamily buildings, typically highly stable when you have a balance sheet as strong as Pepsi, some Montessori schools in Texas. And you can see they're geographically diverse. That's a big attraction to our investors is being able to be geographically diversified. Here's a little bit about 1031 exchanges that I'm probably not going to get into today, since most people want to focus on debt-free. So, ladies and gentlemen, when it comes to debt-free opportunities in real estate, we have two options, funds and DSTs. And when you're thinking of the two and the different strategies, think of funds as opportunities where you put a little bit of money into, and then these investments grow over time and you become more and more diversified over time. And you could potentially have somewhat of a risk against inflation and a risk against deflation. That's why I invested in these funds. Now, you may not have as much upside potential that you would have if you took on a fund that was leveraged. But you ask yourself, where are we in the economy? Do you really think being in a leveraged fund is a good idea, especially if you're not getting as much income? Would you rather be in a fund that can cost dollar average as the market recedes, knowing there's no bank to cash flow sweep or foreclose on your asset? Or do you want to risk it and pray that you make it through a recession and then there's an upswing in the market and you can take advantage of that leverage, right? So you got to kind of consider what your risk tolerance is and what your appetite is for a return and make those adjustments. And that's what we're here for, is to help walk you through that. And on the DST side, those are single or multiple assets that do not change once you invest in them. So you choose to be how diversified you want to be at the point of investment. So you can pick one DST, you can pick multiple DSTs, and you can choose how diverse you want to be. But until they sell those properties, what you see is what you get. These DSTs are not going to be buying and selling property within those Delaware statutory trusts. They're fixed, they're stable, they're boring. And whatever potential appreciation there is in those DSTs, the investors are entitled to all of it, unlike the fund where you're splitting it with the sponsor. But in the DSTs, you're going to 1031 exchange potentially on the back end, preserving all of that wealth that you did not give to Uncle Sam. Or in a fund, you're going to have to pay taxes once it liquidates, because you cannot 1031 in or out of an LLC. But to everyone in the audience, those are two debt-free options that K Properties provide. And on the screen, you can see kind of some education products that we offer. And we're really big on education. So give me a call, give us a call. My email is steve@kpi1031.com. That's Steve, STEVE, @kpi1031.com. And here's the contact information for our team here as well. And Alexandra, back over to you for some Q&A.
Yes, thank you so much for that presentation. I will go ahead and pull up some questions here, but in the meantime, let me actually launch a poll for you all so you can get access to some of these debt-free listings, so they can provide you with like a whole list of what they have available right now. If you say yes to that, we'll go ahead and send that to you afterward. Now, we did get some questions. Keith was asking, please confirm a person offering a DST has to be a Series 7, Series 6. Additionally, does the client get a Form ADV as well?
So in a DST, to sell private securities, Series 7 does allow you to sell DSTs. You can also have a 22 and a 63 and pass the SIE. So there's those couple of different choices there. And as far as the, what was the other one, Alexandra? What was that last part that you asked?
Yeah, if the client gets a Form ADV as well.
A Form ADV. I'm not familiar with that, so I'm not sure about the Form ADV.
Okay. Yeah, I'm not sure either. I haven't heard of that one yet, but maybe we could look into it for you after.
Yeah.
Frank asked, what is your DST performance history over the last 10 to 15 years?
So we've been involved with somewhere over 30 billion in DST real estate,
Wow.
and it's been an awesome market. Now there have been some black eyes, especially like through COVID, especially in student housing sector, and some of those are struggling. So we're staying away from student housing, and we have learned some lessons. But overall, I mean, it's not very. I don't think it's very helpful to tell people our track record over since we, Dwight started off on his own around the recession, and things have done fantastic overall. Now, not all of them, some have been lukewarm, but I don't think it's going to continue like it has been over the next few years. So we're going to be operating like we're pretty pessimistic. So we're posturing for holding power. This is probably the smallest our property menu has ever been that I'm aware of. We're working with the least amount of sponsors that we have in the past because Dwight and his analyst team are being very strict about what we are allow on our platform compared to what we have been in the past.
Mm.
But if clients want to go over track records and things like that, what we usually do with our clients is go through the track records of the specific sponsors that we're working with. So if we build a portfolio for them, we might suggest 3 or 4 different sponsors that they invest with. And then we'll look at the track record of those sponsors to make sure that they're comfortable with the projects of which they're investing.
Yeah, that makes a lot of sense. It's more sponsor based than anything, and that's part of the service that you all offer is to vet those sponsors. And so knowing how those did in the past could be helpful, but I am glad that you're taking a conservative approach moving forward. That's definitely the best way to go about it. And it's good to have a company that adjusts to the market. So it sounds like you're doing that. Um, we have Steve Sun who's asking, what is the range of holding periods of your debt-free DSTs?
I think typically they're going to average 5 to 7 years, just like everything else. However, I think in the past they've been really short
Mm.
over the last 7 years. And that's because the real estate market's been so hot that we've been able to turn these properties around for typically a really nice return in a short amount of time, to give the investors their money back to figure, what they want to do with it at that point. But I think in the future, that's going to be extended because the market's going to be a little bit slower in return. So I think probably 7, 8 years is probably what you can expect from here on out. But if we get into trouble, heck, it could be over 10. If a property's struggling and we need to re-tenant a building or something like that. So I always tell our clients, these are not liquid. We can sell their shares to another buyer if they want to get out, but I can't guarantee that they're going to get the price they want. And just plan on being in these things for a long period of time.
Yeah, that makes sense. And we know that real estate is cyclical and those cycles sometimes can be shorter or longer, and you sometimes have to wait it out. So I think it's a good place to place your money if you're not looking to use it anytime soon and you also don't want to deal with the hassles of rental property management. So that's a good point. Steve also asked, what are the top 3 sponsors you would recommend?
Oh, well, it really depends on what you're looking for. There's some sponsors that are really good at multifamily, others, specialize in net lease. Some sponsors have provided better returns than others overall, but then some sponsors have done very well, and I've seen them go through tough times, and they may not have as good of returns overall, but I've seen how they've handled my investors' money when crisis has taken place, and they did a great job. So it really depends on what the investor is looking for. And since we have such long-standing relationships with these sponsors, like we play a little bit of matchmaker. So I wouldn't say that I like a top 3 more than others. It just really depends on the situation. I'd probably say there's about 15 that we regularly do business with.
That's great. That's a good amount of choices. And I think you're right. It does depend on what's important. There isn't a one size fits all kind of approach there. So, for those of you who did answer that you wanted those DST listings, we'll be in touch with those afterward. I did put Steve's email address in the chat if you want to copy that, but I will also share his email tomorrow in the follow-up email. The follow-up will have the full recording and Steve's info so you can get access to that. And Steve, thank you so much for your time. This was really excellent information. I think it's very relevant today in the market that we're at. So I'm glad you put it in that context. I hope to have you again soon. And yeah, thank you. Appreciate it.
Yeah, it's great seeing you, Alexander. I'm so sorry I couldn't get my camera to work. I'll have a new computer next time and be ready to
Okay.
go. But all
Okay.
right,
Good.
take care.
All right, everyone. Have a wonderful day. Take care. Bye.